Whenever we enter markets, whether it be to speculate or invest, our ultimate aim is to generate a profit. We want to finish the time period over which we invest with more money than we started. And it doesn't really matter whether that is a day, a week, a month, a year, 10 years. So we are always asking the question, is our speculation worth the effort? And this is a question that people who trade ask themselves all the time. And in fact, many of our metrics are risk-based. They're asking the question, is my return worth the risk I'm taking? Very rarely, it seems to me, is this question asked of longer-term portfolios. People who have the habit of simply buying stocks and holding them don't necessarily ask themselves these questions. So what I want to do is take a quick look at this notion of whether long-term investment portfolios being worth the effort. There's a little bit to unpack in this question before we begin. And it's this notion first of what is a long-term investment. Well, traditionally long-term investments last for periods of 10 years or greater. That seems to be their landmark criteria. But traditionally, they are passive in nature. What happens is people simply buy a group of investments and hang on to them. And occasionally at the end of the month, they'll look at the Australian Financial Review and try and find the share price and see how they're doing. But they are very, let's call it lazy in their approach. And so the question is, does this laziness or this lack of input have some form of payoff? Traditionally, they're drawn from a closed universe, something like the S&P ASX 200 or the 300. This in and of itself is not an issue, simply because many traders also do the same thing. And in doing that, what they're undertaking is forcing the market to do part of the selection criteria for them. So they're restricting the universe. One of the great myths of trading and even investing is that people believe that they will be buying and selling every conceivable instrument in the world. This is not true, because the majority of instruments in the world are not worth buying or selling or holding. And this is particularly true of Australia, where the market suffers from severe pockets of illiquidity. There is simply not enough interest in stocks to make them viable for people who might have sizable amounts to invest. It is only once we get within this universe of the ASX 200 and 300 that often there is viable depth within a given stock to take a position. And this question as to whether they're worth the effort is a slightly more complex one, and one which will require us to look at a benchmark, some form of comparison with which we can say, well, we do better or we do worse. But within that, we need this notion that we need to generate a return beyond that of the market. That is simply something that we're forced to do. Traditionally, we would want to do this with minimal drawdown. Drawdown can be referred to as a pain index for people. It is the amount of pain they are willing to bear to generate a return. Drawdown and return do have a relationship. And traditionally, what you would expect is that the higher the return, the higher the drawdown. Likewise, if you're getting a severe drawdown, you would expect at some stage that you have got some form of dramatic payoff. You do not want to have what you consider to be a blue chip portfolio that suffers horrendous drawdowns. That to some degree defeats the purpose of it being passive. As an example, perhaps from the absurd, this is a chart of Chalice Mining, and along the bottom is this notion of investment growth. Investment growth simply says, well, if I put $10,000 into this stock at the beginning of this chart, what is it worth at the end of this review point? And at the end of this review point, every $10,000 is worth $134,000. So it's a substantial payoff for a period of about 18 months. But if we're to look at this in terms of the drawdown one might experience by being an investor in Chalice, you need to be able to weather drawdowns in excess of 60, 70% to generate that sort of return. This is the symmetry between drawdown and return. And it's the job of the trader to try and manage this relationship. Passive investors don't. They will attempt to ride through these periods. And unfortunately, as a passive investor, you can have periods where your stock is in drawdown for 10 or 15 years and it simply goes nowhere and makes no contribution to your portfolio at all. But in looking at this notion of passive portfolios, I needed a universe from which to draw a series of stocks that I could invest a fixed amount of money into. So what I did was I picked the S&P ASX 20. You could consider these the most blue chip stocks we have, and I constructed a list of what was part of the ASX 20 from 10 years ago. Now you will note, those of you who are very quick at counting will see that there's only 19 stocks here, not 20. That's occurred because I dumped Westfield. Westfield was delisted in 2018. And so I did not want to go through the hassle of trying to deal with a stock that had been delisted from a fixed investment portfolio. So when I look at this portfolio for the past 10 years, and I look at the individual components, I've got three things noted here. I've got the 10-year return, so the return from the point of start to now, the compound annual growth rate, and the maximum drawdown. And you'll see here there are three stocks that have had a negative compound annual growth rate: AMP, Origin, and Santos. What is also interesting here is the maximum drawdown that each one has experienced. And I'll loop back to this maximum drawdown in a moment because it's an important consideration. When I look at building my portfolio, all I said to myself was, well, I have $10,000 to allocate to each one of these shares. And this is the portfolio that was generated. So we've got the stock purchase price, the number I could buy, the current price, the current value, and the gain or loss over that 10-year period. And this portfolio started with $190,000. It, at the point at which I constructed this spreadsheet, had a value of $415,334.83. A gain of slightly over $225,000. So the portfolio has more than doubled in 10 years. And when I look at the distribution of returns, that is, who contributed the most, we can see our three duds down the bottom. But we can also see that the majority of the returns have come from three stocks: Macquarie, CSL, and Rio. That in and of itself is not a bad thing, because when you look at traders' portfolios, their returns tend to come from a small handful of trades. One of the mistakes that people make in thinking about trading is that they think that every time they trade, they will be given a certain amount of money. That's not true. Your cash flow as a trader is very lumpy, and it's quite possible to go an entire 11 months without making any money and to make all of it in the 12th month. That's just the nature of trading. And so that in and of itself is not an unusual feature. And when I look at the average compound annual growth rate for this portfolio, it's 8.13%. It's not brilliant, it's not bad, let's call it average because it pretty much is. I said I'd return to this notion of drawdown. The portfolio itself, if I make a very blunt average, and averages are blunt and they're a little bit dirty, so we need to be a little bit careful. The average drawdown for the portfolio was 51%, almost 52%. But you can see that the maximum drawdown for the worst three was extreme. And we're not managing these drawdowns, so you would need to be capable of absorbing the pain of doing a great deal of damage to your portfolio by simply holding three particular stocks. But what is interesting is the extreme drawdown that blue chip stocks are capable of. And remember, we need this symmetry between drawdown and return if we are to think that this is worthwhile. The problem here is we have a maximum drawdown over that 10-year period, or an average drawdown, let me rephrase that, an average drawdown for the portfolio of almost 52%. But the compound annual growth rate is only 8.13%. So we're starting to build in an asymmetry. And if we look at the compound annual growth rate for all of these stocks, there is an asymmetry that somewhere along the line, this portfolio has taken an horrendous hit. But there is not something generating an extreme outlier return to compensate for that. Yes, things like CSL and Macquarie have done well, but they're certainly not of the order of, say, trading something like Chalice. And this is the important point, that when you look at your portfolio, you need to be able to say, yes, I've taken a hit, but I've more than made up for it on this. I mentioned that we needed a benchmark, and conveniently there is an ASX 20 ETF. And when I look at the return doing exactly the same exercise for this ETF, I get a gain of $182,494.80. So it is less than my equally weighted buy and hold portfolio. And when I break these statistics down, the annual compound growth rate is lower at 6.97% versus 8.13%. The maximum drawdown is about the same. That's as you would expect. It is almost identical. So there's nothing really to generate from that differential. So the question becomes, well, if you've got an ETF that mimics this portfolio, but it performs worse than the portfolio, why is that? And it comes down to this notion of the way the indices like the S&P ASX 200, the 100, the 50, the 20 are calculated and presented to us. They're what's known as capitalisation indices. So they're put together based upon the weight of the stock within the market itself, within its size. They're constructed based on the size of the stock. With an equal weight portfolio, we just simply say, well, I've got X amount. I'm going to allocate a fixed portion to everyone. But something interesting happens when we start to look at our bog standard indices versus our equal weight indices. This is a comparison with the ASX 200, standard index and equal weight. And you can see that the standard index outperforms the equal weight index for this entire period under consideration. And this relationship holds true for, as you would expect, for foreign indices. This is the NASDAQ 100 versus the NASDAQ 100 equal weighted. And you can see there is a substantial differential. So this raises the question, why the difference? And the difference simply comes about because of the nature of weighting. Our portfolio has a different weighting to the weighting you would expect in a capitalisation indexed based tool. And this is from the S&P ASX 200. And these are the weightings of the top 10 stocks. And you can see if I were to build an equally weighted portfolio based upon the ASX 200, all stocks would get 0.5%. But when I look at the way the index is actually constructed and truly constructed, I see that BHP has a weighting of 10.44%, CSL 6.1%, Macquarie 2.93%. So you have this dramatic difference in weighting. And this dramatic difference in weighting explains the difference in performance. And I'm going to circle back to that because it does have an impact upon performance. I was not able to find the weighting for these particular stocks in the ASX 20 at the time I performed this exercise. So I wasn't able to go back in time and say, right, in 2013, what was the weighting of these stocks? But what I could find was the current weighting of these stocks within the index. The thing to note about indices is they churn. And I think since 2013 to today, there's been 64 different components of the ASX 20. So indices are not fixed. They're very fluid, particularly here in Australia, where we have a very limited pool of talent to draw from. And what we can see here is that in my equal weighted portfolio, I've cheated a little bit and I've given everybody 5%, so I've rounded down a little bit. But you can see the differentials in weighting. And this differential has a dramatic impact. And it has a dramatic impact because sometimes you will fluke a higher weighting in the equal weighting portfolio than you would otherwise expect in the base index. And this is more likely to occur in smaller indices, such as the ASX 20, as opposed to the ASX 100, 200, 300. Because what happens is that differential washes out. The more and more stocks you have, the lower the average weighting for an equal weighting portfolio becomes. And so you get this disparity in performance. This is why when we looked at the ASX 200, the equal weighted version did quite poorly. That's because everyone's getting a smaller and smaller allocation. So you're not going to get these instances where you have a high percentage allocation that happens to match a stock that does very, very well. I thought for interest's sake, I would also look at what happened to the portfolio if my top 3 performing stocks generated merely an average return. And so I simply altered the total return and I've given them the average return for all the stocks. And you can see that the return drops to $144,895.85, a substantial drop-off. This indicates or reinforces that our returns have come from simply these 3 stocks. If these 3 stocks were ordinary, then returns drop dramatically. But I wanted to have a look at this notion of what happens when you broaden out the ETF, because we looked at the performance of an equal weight ASX 200 versus the base index, and I wanted to look at this notion of what happens when you broaden that out and see how broader based ETFs do. VAS is an ETF based upon the ASX 300, and you can see it has a lift in performance. It's not dramatic, but it is still worthwhile. This occurs simply because you're casting a wider net. You're looking at a much, much bigger universe. So within that universe, despite the fact that weightings can be a problem, you are going to get stocks being brought into the index that are doing very, very well. They may have a small weighting, but they are still doing well, and they make modest, almost compounding contributions to the way the index performs. So as a tangential point, if someone's considering an ETF that replicates the performance of the broader market, or which they wish to use to generate a better return, one of the things to do is actually compare the performance of ETFs, compare the performance of indices. Do not assume that they're all the same. Do not assume that the 20 is the same as the 50, same as the 100, same as the 200, same as the 300, because they're not. And again, we can come back to this notion of looking at weightings within indices. These are the weightings within VAS, the ASX 300 ETF, versus this notion of an equally weighted 300 portfolio. And what I've done here is taken the top 10, but also the bottom 10. So you can see the dramatic impact and difference of weightings. BHP has a weighting of 10.3, but BBN has a weighting of 0.01. Their weightings become so small as to be worthless. So despite our diversion into the comparison between equal weighted portfolios versus their base index, I want to swing back to this question, because has the data given us an answer to this? And I think in a nuanced way it has. So the question was, are long-term investment portfolios worth the effort? And I think the answer is yes, but with a massive qualifier. If you get lucky. If you happen to fluke upon the likes of a Macquarie or a CSL, then your portfolio will do very well. And you might say, well, isn't all of investing / trading based upon luck? And to some degree, I would agree with you. I would say that that's a true and fair comment. But I would also add the qualifier that within markets, there are different sorts of luck. There is the luck that traders create for themselves by having a systematic approach to the instruments they trade and the risks involved in trading those instruments. But more importantly, they have a mechanism for recognizing which instruments are doing well and which are not, and dumping those which are not doing well. So, for example, if a trader had our initial portfolio, their approach would have been to manage the drawdown. So it's quite possible that all those stocks would have been dropped from the portfolio at some point during their tremendous drawdown, and then the portfolio reconstructed again. So you would miss out on that dead space where the portfolio collapses and does nothing. Your portfolio does something, goes into cash, and then reinitiates itself. The second form of luck is the luck that these sorts of portfolio depends upon. And that is merely the hope that you have bought something that performs, and the hope that it continues to perform over the next decade, and the hope that it does not go the way of AMP and craters itself into the ground.